Kia ora, and welcome to the CoreLogic Property Market Update for Whiringa Arangi, November 2024. There are signs the housing downturn across Aotearoa is levelling out, but they remain relatively faint. The CoreLogic Home Value Index, or HVI, for Aotearoa fell 0.5% in October, following a 0.4% fall in September. But importantly, both were a noticeably reduced rate of decline than experienced for the 4 months prior, each down 0.8% or more. The median property value across the country now sits at $806,000. Value change is mixed across the main centres, with Te Whanganui-Atara, Wellington City, down 1.5% over the month, and along with Auckland City, the old council area, the median value today is only 3.5% higher than prior to COVID, almost 5 years ago now. Kirikiriroa, Hamilton, along with Tamaki Makaurau, the Auckland super city, experienced a 0.7% fall in October, while in Ōtepoti Dunedin, the fall was a more modest 0.4%. Values tracked sideways over the month in Tauranga and increased by 0.2% in Ōtautahi Christchurch. Something holding the recovery back, despite improving borrowing conditions, is the regular flow of new listings contributing to the increasing and already high level of advertised supply. Total listings are now 12% higher than the same time last year, and 79% up on 2021. This is providing a very different backdrop for market growth than what we saw back then. It's never easy to buy that first property, but a group of buyers who are seemingly managing to make the current market conditions work for them are first home buyers. As reported in the CoreLogic First Home Buyer Report for Q3, they've remained a key presence throughout the year, consistently accounting for around 26% to 27% of purchases, comfortably above the long-term average of 21%. Further, their share of October sales rose to a new high of 27.8%. Meanwhile, multiple property owners using a mortgage to secure their purchase continue to pick up a growing share of monthly sales, up to 23.3% in October, from 20.6% in April, and their largest share for 3 years. It's likely all the regulatory improvements, including the shortening of the Bright Line test, reintroduction of interest deductibility, and loosened loan-to-value ratio requirements are having an impact, alongside falling interest rates and improved growth prospects. On the flip side, owner-occupiers moving house have been quieter. Their share fell to 24.5% in October, with perhaps the weak and weakening labour market playing the greatest part in keeping these mortgage holders cautious, despite falling interest rates. Certainly, the dramatic fall in Wellington, where job insecurity feels the worst, offers further evidence of this hypothesis. Movers accounted for only 15% of purchases in October, well down on the 20+%, which is the regular norm. Speaking of the labour market, the official data for Q3 was seen as the last big data release for the Reserve Bank to consider before their final meeting and OCR decision of the year at the end of November. The headline unemployment rate at 4.8% was better than the expected 5%. However, there is a weak underbelly, with both employment and the participation rate falling, indicating an increased number of people giving up on finding work and leaving the labour force. We still have an economy and labour market requiring support then, and that will likely mean the Reserve Bank follows through with another cut to the official cash rate. The question will be by how much, and while a 75 basis point cut shouldn't be ruled out, a look back through history shows cuts of that size are typically reserved for emergencies. And while things are tough out there, I think it's hard to call it an emergency right now. A 50 basis point fall is therefore more likely, with the bank to then monitor market reaction over the summer months, before they meet again in February. The lack of any evidence to panic about the economy or financial system was reinforced by the latest financial stability report too. It came and went quickly, with the Reserve Bank comfortable that the trading banks are resilient to a wide range of future shocks. Part of that is because of regulations we already have, such as the loan-to-value ratio rules, with the debt-to-income limits likely to play an increasingly important role in the coming few years. Further afield, there's been plenty of interest in the result of the US election. President Trump is a polarising figure, and some policy discussion has prompted expectations of a weakened New Zealand dollar and difficulty for our exporters. However, aside from some short-term uncertainty, the New Zealand property market is likely to be pretty insulated from any dramatic global shifts. Back home, there was another announcement regarding the construction sector, with the government signalling an intention to allow some builders to self-certify. The intent is laudable, to improve the speed, cost and efficiency of getting houses built. However, it's not without industry concerns over quality, particularly from the banking and insurance companies. Another one for the watch list then. And as usual, we'll keep a close eye on any and all developments when it comes to property and property data in New Zealand. Make sure you follow all news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook. Don't forget to download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.